Welcome to ZZ Financial. We are committed to providing the most accurate, valuable, and timely information and analysis.
No, it's August 25th, Monday. And here on the East Coast, it's pretty late, 10 p.m. West Coast, it's 7 p.m. And I'm just really curious about today's financial headlines, aren't you?
Always something happening.
It really feels like we're constantly on the edge of, major shifts, and today's news is certainly no exception. Today, we're doing a deep dive into what feels like an incredibly dynamic period in global finance.
It really does.
We've gathered insights from all over the U.S., Japan, Singapore, China, trying to uncover the forces really shaping the economic landscape right now. We're looking at, well, everything. Central bank policies, geopolitical trade tensions.
Which have been significant.
Absolutely. And the relentless march of AI, its impact on industries, plus some fascinating company-specific stories. Our mission here, for you, is to connect these seemingly separate dots, help you understand the bigger picture and what these complex movements might mean for your world, your decisions.
Indeed. And what you'll see today is this complex, sometimes contradictory interplay. You've got expected policy shifts from, say, central banks, and then these unexpected, sometimes almost seismic political interventions.
Right.
All these forces are hitting market sentiment at the same time, reshaping investment strategies, changing the whole economic narrative, really. It's a perfect illustration of just how fast the financial story can evolve.
Yeah.
You need constant vigilance, a deeper understanding of what's underneath. So yeah, let's unpack this. Let's really dig into the details.
Okay, let's start unpacking with what seemed like a clear signal, at least initially, from Fed Chair Jerome Powell. We saw this immediate wave of optimism sweep through markets after his remarks at Jackson Hole on August 22nd. U.S. stocks, for instance, the Dow Jones, surged over $900 points at one point, hit an 8-month high.
Pretty dramatic reaction.
Totally. And it was all based on these hints, right, about a possible interest rate cut in September, citing employment risks. It just felt like this collective sigh of relief from investors.
That's right. The initial reaction was quite strong. And it wasn't just limited to the U.S. What's interesting is how quickly global markets picked up on those signals.
Yeah, I noticed that too.
We saw a similar feeling boosting the ST index in Singapore. It rose for a fifth straight day on August 25th, up just 0.08%, but still up. And it was fueled by those same U.S. rate cut hopes.
Okay.
Critically, we saw really strong buying in the real estate sector. And this was helped along by the July Consumer Price Index, the CPI, from Singapore's monetary authority. It rose only 0.6% year on year, which was actually down from June's 0.8%.
So inflation easing a bit there.
Exactly. That local data supported the view of steady consumption. It boosted investor sentiment. And we saw specific real estate investment trusts, REITs, like Mapletree Industrial Trust and Fraser's Logistics and Commercial Trust, plus City Developments, all posting gains. Even Japanese stocks jumped initially. The Nikkei average surged over 500 yen, reflecting that immediate global wave of optimism.
It's incredible, though, how just a hint from Powell, not even a firm announcement, can set off such a widespread, almost instant reaction across different markets, even places like Singapore and Japan. Why is that? What makes the prospect of U.S. rate cuts so globally powerful? Why does the market jump on just suggestions?
That's a really sharp question, and it really highlights two things. How fundamentally interconnected the global financial system is, and crucially, how markets operate on expectations.
Expectations, right.
You see, Powell's words, even if they're cautious, maybe conditional, they're seen as huge signals. Why? Because the U.S. dollar is still the world's main reserve currency, and the Fed's policy basically sets the benchmark for global borrowing costs.
Okay, so it ripples outwards.
Exactly. Lower interest rates fundamentally mean cheaper borrowing for businesses, for consumers, pretty much everywhere. This lower cost of capital can spur economic activity. Companies find it cheaper to expand, invest, hire. Consumers find it easier to buy things, big things like homes, cars. And that, in turn, can boost company profits, making stocks, equities look more attractive compared to, say, bonds, which might offer less return in that environment.
So it's not just a U.S. thing. It's like turning on a global liquidity tap, sort of.
That's a good way to put it.
Yeah.
A global liquidity tap. And for sectors like real estate, which you mentioned popped in Singapore, the link is even more direct. Lower rates usually mean lower mortgage costs.
Makes houses more affordable.
Precisely. Increases affordability, boosts demand for property. That directly fuels positive sentiment. Investment flows into that sector. And the easing CPI in Singapore, that added a vital layer of local confidence. It suggested their own economy could handle steady consumption without immediate inflation fears.
Ah, okay.
So those U.S. rate cut hopes look even better locally, promising a kind of gentle environment for growth. But it's important to remember, while global markets are connected, local factors are always in play. Well, things like caution over high valuations after a run-up, or just simple profit-taking.
Hmm.
We saw how that initial surge in Japanese stocks kind of faded, right? Gains got smaller because of selling pressure.
Yeah.
So it shows that while global signals might kick things off, local realities really determine if it lasts. It's this constant, complex dance between the global music and the local dancers, if you will.
I get the initial optimism, but then things took a really interesting and maybe unpredictable turn with what we're calling the Trump effect. Early on August 26th, JST, so late evening the 25th here ET, President Trump announced on social media the immediate dismissal of Fed Governor Cook.
Yes, that was sudden.
Citing allegations of fraudulent mortgage applications, the market reaction was fast and complicated, right? U.S. two-year bond yields dropped sharply, almost hit 3.67%, down 0.05% from the NY close, which immediately made people think, okay, maybe a successor more favorable to Trump's desired rate cuts is coming?
That was the immediate interpretation, yes.
Wait, but then U.S. long-term yields, like the 10-year bond at 4.28%, actually ticked up slightly, reflecting a different kind of worry.
A very different kind of worry.
And get this, in Tokyo, the yen strengthened against the dollar, hitting the upper 146 yen range. More dollar selling, yen buying. This even pressured Japanese exporters like Toyota.
Indeed, Governor Cook's dismissal was definitely an unexpected event. It threw a new layer of uncertainty onto what was maybe shaping up to be a more policy-driven story. You've highlighted a critical moment that really underscores how fragile market confidence can be.
So the market's reaction to this dismissal, especially that split in bond yields and the yen moving, it really shines a light on this idea of Fed independence. Why is that so important? Why does messing with it, or even the perception of messing with it, cause such a strong reaction?
That's such a crucial point. You're hitting on a bedrock principle of global finance. Federal Reserve independence means its decisions on monetary policies should be based purely on economic data, analysis, and its mandate maximum employment, stable prices, shielded from short-term political pressure. This wasn't always the case. Historically, there were periods where political meddling led to really bad economic outcomes, runaway inflation. So this independence was hard-won, and it's seen as absolutely vital for maintaining credibility, both at home and internationally.
So it's about trust in the system's stability.
Exactly. If the market even thinks interest rates might be set based on political desires instead of economic need, it injects enormous uncertainty about the future. Future rates, future inflation. It fundamentally undermines confidence in the whole economic framework.
That makes sense why the reaction was so strong.
Precisely. Now let's look at that split reaction in the bond market again, because it tells a fascinating story. That sharp drop in the two-year yield, that reflects the immediate speculation or hope maybe that a more dovish, rate-cutting, friendly Fed governor would be appointed. Short-term bonds react very quickly to immediate policy expectations.
Okay, so short-term hope.
Right. But the simultaneous rise in longer-term yields, like the 10-year, that signals a deeper worry. Investors are basically demanding a higher return, a higher yield, for holding those longer bonds because of increased policy uncertainty and potential future inflation risk.
Why inflation risk?
Well, if monetary policy becomes less predictable, or if the Fed seems less committed to fighting inflation because of political pressure, investors worry inflation might get out of control down the line, so they demand a higher yield now to compensate for that future risk. This split shows a real conflict in market thinking. Short-term hope for cuts versus long-term worry about stability.
Wow.
And connecting this globally, the yen strengthening against the dollar is also part of this reaction. It's driven by people selling dollars because of this uncertainty, this perceived risk to U.S. assets. When global investors get nervous about U.S. policy or stability, they sometimes look for safe havens. The yen can act like one sometimes, or they just sell dollar assets.
Pushing the dollar down, yen up.
Exactly. Which, in turn, hurts Japanese exporters like Toyota. A stronger yen makes their cars more expensive overseas and cuts the value of their foreign earnings when they bring the money home. It's this really intricate web where one political action triggers financial waves across continents.
Wow, that's a lot to take in. But the Trump effect didn't end there. We also saw this renewed focus on government intervention, tariffs. Over the weekend, the U.S. government agreed to buy a 10% stake in Intel.
Yes, that was another significant move.
President Trump supported it, hoping to see more cases like this, saw it as good for national property prosperity. But Intel itself sounded a bit cautious in its SEC filings, warning about potential negative reactions from investors, employees, customers, suppliers, even foreign governments, maybe lawsuits.
They seem particularly concerned about the interplay with tariff policies.
Right, how tariffs could hit their overseas revenue. Then, on August 22nd, Trump announced an investigation into possible tariffs on imported furniture. And we saw the impact immediately on U.S. retailers. Wayfair down 9.5%, RH down 10%. RH gets like 72% of its imports from Asia.
High exposure there.
Definitely sparked fears about profits eroding, demand falling if they pass costs to consumers. But interestingly, companies like La-Z-Boy, Ethan Allen, with more North American production, their stocks actually did better.
Seen as relatively insulated, perhaps even beneficiaries.
Right. And then, capping it off, evening of the 25th, Trump announced plans for significant additional tariffs and semiconductor export controls, targeting countries with digital taxes or regulations on U.S. tech firms, called them discriminatory measures.
Specifically mentioning they were aimed at U.S. tech while ignoring Chinese tech giants.
Exactly. And these policies, they're already showing up in the data. The Netherlands Bureau for Economic Policy Analysis, CPB, reported on the 25th that global goods trade volume fell 0.3% month-on-month in June. That's the third straight month of decline.
First time in 2.5 years, they said.
Yeah. And they directly linked it to the Trump administration's tariff policies. U.S. imports in June, down 4.5% month-on-month, lowest in a year and a half. When we look at these tariffs, these interventions, is the main goal really protecting American jobs? Or is there something more complicated going on? And how can one country's tariffs have such a broad impact, causing a 3-month global trade dip? It seems like a really blunt tool.
It is a complex issue, and your question really gets to the heart of the whole protectionism debate. While the stated goal is often, yes, protecting domestic industries and jobs by making foreign goods more expensive, the key thing to grasp is that tariffs, while framed as protection, often act like a global tax on efficiency.
A tax on efficiency? How so?
Well, they don't just make imports pricier. They fundamentally break apart these cost-optimized supply chains that businesses have built over decades. That directly leads to the kind of broad trade contraction the CPB report showed. It's a blunt instrument, like you said, and it often ends up hurting the very prosperity it claims to protect, or at least significantly changing its path.
So it's not just about made in USA versus imports directly. It's the whole intricate chain.
Exactly. Tariffs are basically taxes on imported goods.
Yeah.
They raise the cost of foreign products, which theoretically encourages buying domestic. But, as you noted, the effects ripple out and are often counterproductive. They raise costs for domestic businesses, too, if those businesses rely on imported parts or materials.
Which then gets passed on to consumers.
Often, yes, fueling inflation. And that's where the big impact on global trade comes in. When a huge economy like the U.S. imposes tariffs, it causes massive disruptions. Businesses worldwide have built these incredibly complex networks, sourcing here, manufacturing there, distributing everywhere, often crossing multiple borders, precisely because it was the most efficient, cheapest way under free trade.
Like a finely tuned machine.
Think of it like a global symphony orchestra, meticulously planned. Suddenly, some key players are told they can only use instruments made in their home country, or their sheet music gets a surprise tax. The whole performance, built on international collaboration and efficiency, just becomes disjointed, expensive, less effective.
That's a good analogy.
That's basically what tariffs do to supply chains. They create huge uncertainty. Businesses have to rethink everything. This leads to delays, higher costs, and often retaliation other countries slap on their own tariffs. That shrinks the total volume of goods traded internationally. It flies in the face of the free trade principles that drove global growth for decades.
Hence the decline the CPB reported.
Exactly. 3 straight months of decline in global trade volume is a clear, tangible result of these policies. And as you touched on, it adds to inflation pressures at home too, because those taxed imports get more expensive for consumers. That was likely a factor in the Dow's decline we mentioned earlier. It's a really delicate balance, and the ripple effects are often much wider, much deeper than first expected.
We've just unpacked how politics and trade policy are adding this layer of unpredictability. But let's pivot to another huge force, maybe even more fundamental, definitely more technology-driven. The AI revolution. It feels like it's reshaping everything, even the software industry's foundations, doesn't it?
It certainly feels that way. The pace of change is incredible.
We're seeing big U.S. software stocks like Salesforce, Adobe, ServiceNow. They're performing pretty poorly, down 26%, 19%, 16% respectively since the end of 2024. The S&P Software and Services Index was actually down 0.4%, which is striking compared to the Nasdaq's 11% rise.
A huge divergence.
Yeah. It seems driven by this growing pessimism. People are even talking about the death of software.
Yes, that death of software idea is definitely causing a lot of anxiety for investors, especially those used to the steady, predictable growth of the software as a service or SaaS model.
Right. The subscription model seems so solid.
Exactly. And the pessimism comes down to really two main things. First, this fundamental threat to the high-profit SaaS model, which relies on subscription fees based on human users from something called AI agents.
AI agents, what are those exactly?
Think of them as programs where AI can autonomously handle tasks that humans used to do. Microsoft CEO Satya Nadella even hinted at the death of SaaS back in 2024, sparking this whole debate about whether the way we use and value software is fundamentally changing.
This death of SaaS idea, driven by AI agents, sounds pretty dramatic. If AI agents do automate a lot of human tasks, what are the biggest immediate impacts on those SaaS revenue models beyond just the billing per user? And maybe more importantly, how does this redefine the role of software engineers? Does it mean fewer jobs?
That's a really insightful way to frame it, and it gets right to the core of this transformation. An AI agent isn't just, another feature. It's a basic shift in how work gets done. Imagine an AI agent as like an autonomous digital helper, using AI to achieve goals, often mimicking human-like actions.
Okay.
So instead of a person logging into Salesforce, say, to update a customer record or write an email or generate a report, an AI agent could potentially just do that automatically in the background, without needing direct human input for every single step.
I see. The AI takes over routine actions.
Precisely. And the profound implications for those stable SaaS subscriptions are layered. First, if tasks that needed a human login are now automated by AI, well, the need for that human to subscribe for that task goes down, right?
Yeah, that challenges the user-based billing.
Directly. Why pay for 100 human licenses if 50 AI agents can do the same, or maybe even more, work? The value shifts from seats to maybe outcomes achieved or compute power used. Second, there's this idea of a value transfer. If the AI agent does the work, maybe the main value isn't in the SaaS application itself anymore. Maybe it's in the AI agent technology, the underlying large language model or LLM it uses, or the platform managing these agents.
So the SaaS company becomes less central, maybe just a data source.
Potentially, or their role changes significantly. They absolutely need to adapt and fast. Now, does this mean joblessness for software engineers? Not necessarily, but it definitely means a huge transformation in their roles. Instead of building, say, repetitive features for humans to click on, engineers might shift focus to developing, integrating, or managing these AI agents, building the AI-driven workflows. It's about embedding the intelligence into the system, making it more autonomous.
Just different skills needed.
Absolutely. Less traditional coding, perhaps, more prompt engineering, AI model fine-tuning, integrating complex AI services. It's adaptation evolution, not necessarily elimination. But it definitely shakes up the established profit structures and how we value traditional software.
Yeah.
Which raises the big question, how fast can these big SaaS companies pivot?
Right.
And the second reason for pessimism, by the way, is just intense competition and the shockingly low cost of development now with generative AI. OpenAI CEO Sam Altman showed creating a French learning app in minutes using GPT-5. He argued the SaaS industry will soon enter the fast fashion era.
Fast fashion era, meaning quick, cheap, maybe disposable.
Pretty much. More players, faster churn, a real risk of profit margins getting squeezed across the board as it becomes much easier to build software. Now, SaaS companies aren't just sitting there. Salesforce launched Agentforce, trying to integrate AI directly.
Well, trying to adapt.
Yes. And some analysts, like at Goldman Sachs, think AI could actually open a path to sustainable growth for them, leveraging their huge customer bases and data. But others see a major paradigm shift where investment money will have to sift through and find the real winners and losers in this new AI-driven world, who can truly master AI integration and reinvent their value.
That's a fascinating look inside the tech world's own disruption. But what about the global AI race? China seems to be making some really big strategic plays. We heard about this emerging Chinese AI company, DeepSeek, announcing a new LLM v3.1 on August 21st.
Yeah.
And the key detail was that it's explicitly designed for next-generation domestic chips. That sounds like a big statement about AI self-reliance, cutting dependence on U.S. tech like NVIDIA and AMD.
It is a very big statement. China's AI progress is a huge story, and DeepSeek's V3.1 announcement is a critical part of it. It's not just about the model itself, it's the strategy behind it, that push for domestic chips. It's a clear signal China wants to control its entire AI development stack, from the hardware foundation right up to the sophisticated models.
Why is that so important strategically?
It reduces a crucial point of leverage that countries like the U.S. might have in this ongoing tech competition. Control the chips, control the AI future, essentially.
It's clear this is way more than just about better tech specs. This AI race seems fundamentally tied to national power. Could you maybe elaborate on how these chips and LLMs become so central to geopolitical strategy? What's the big picture here for global leadership? Is China really catching up?
You're absolutely right to look beyond the specs. They are, in fact, dead center in these geopolitical power plays. The race for AI dominance, it's fundamentally a race for technological, economic, and yes, even military leadership in the 21st century.
What?
Large language models, LLMs, they're basically the brains of modern AI. They power everything from smart chatbots and assistants to complex data analysis and autonomous systems. And advanced semiconductors, the chips, they're the crucial computing power needed to train these massive LLMs and run them efficiently. They're the engine.
Okay, brains and engine.
Exactly. So control over designing and making these components, it's increasingly seen as critical for national security, economic competitiveness, global influence. It's a new kind of strategic advantage.
So if China develops its own chips for its own AI, it kind of walls itself off from external pressure, like U.S. export controls.
Precisely. Designing LLMs for domestic chips is a strategic imperative for China towards self-sufficiency. It's an aggressive move to get around potential U.S. export restrictions on advanced chips and cut reliance on American tech, which they see as a major vulnerability, a choke point.
Makes sense.
This strategy reduces the ability of countries like the U.S. to slow China's AI progress using supply chain controls. And we saw the market react to this confidence. Cambricon Technologies, often called China's NVIDIA, saw its stock nearly double since late July, including a 20% jump in one day, August 22nd.
Wow.
Goldman Sachs even raised their price target, noting Cambricon helps customers mitigate supply risks from a single company, meaning NVIDIA, especially with U.S. tariff uncertainty and data security worries. It highlights the strategic value of having domestic options.
So this is happening while NVIDIA faces challenges in China.
Yes, it's all interconnected. Former President Trump has floated plans for NVIDIA to pay 15% of its China sales revenue to the U.S. government. That would obviously hit their bottom line hard. Plus, there were reports of production halts for NVIDIA's China-specific AI chip, the H20, even though it was previously allowed under regulations.
Supply uncertainty.
Right. And that uncertainty was even blamed for delaying DeepSeek's earlier R2 model, showing the real-world impact of these restrictions. Now, NVIDIA's earnings are coming up August 27th, highly anticipated. Revenues forecast to jump 53% year-on-year. Huge demand. But concerns remain that NVIDIA might have to exclude sales to China from its revenue forecast because of this whole complex geopolitical mess. It creates an overhang, even with a strong overall demand. Still, about 90% of analysts rate NVIDIA a buy, seeing dips as buying chances, given their clear leadership in the broader AI chip market.
So is this the next DeepSeek shock?
The report mentions that possibility. An earlier DeepSeek shock apparently caused U.S. tech stocks to fall when Chinese players rose unexpectedly. This new V3.1 announcement could potentially cause another big wave in overseas markets like the U.S. The big picture. It's definitely a tech arms race where innovation is tangled up with national policy and geopolitical strategy, shaping the future global power balance.
That's a really high-stakes game. But even within this booming tech sector, some companies are clearly struggling. Like cybersecurity firm SentinelOne dropped 2.8% on August 25th after BTI downgraded them from buy to neutral.
Competition cited as the reason.
Yeah, intense competition from CrowdStrike, Microsoft, Palo Alto Networks. Apparently, it's gotten worse since April, sales agencies missing targets. And then there's Figma, the design software company, down significantly 8.9% on the 25th.
Multiple neutral ratings came out for them.
Right. BofA, Goldman, Morgan Stanley, all initiating with neutral, citing overvaluation despite growth potential. They highlighted risks like losing market share to competition, even user cannibalization from AI automation.
Valuation concerns are common in high-growth tech.
And adding to the mix, Elon Musk's AI company, XAI, filed a lawsuit on the 25th against Apple and OpenAI, alleging illegal hindrance of competition in AI.
The claim being Apple's partnership unfairly advantages OpenAI.
Yeah, by letting OpenAI collect data from billions of iPhone users, limiting AI choices, suppressing xAI's Grok app. They're seeking billions in damages. OpenAI called it harassment.
A major legal battle brewing there.
And even Adtest, a semiconductor equipment maker, fell after Trump mentioned export restrictions, raising profit worries for them. It seems kind of contradictory. AI is booming, Nvidia's flying high, but other tech companies are dipping. Why the difference? Is it just about picking winners and losers, or are there deeper market things happening even within a hot sector like AI?
That's a great point, and it really shows a crucial truth about any big tech shift. Not everyone benefits equally. Even in a booming sector, different pressures lead to very different results. It's definitely not smooth sailing for all, and this is where specific market dynamics, competition, and valuation really matter.
So it's more nuanced than just tech is winning.
Absolutely. Look at SentinelOne. Their issue is fierce competition in a packed market. Cybersecurity is vital, right? But even strong players can struggle to stand out and keep growing fast when giants like Microsoft, with its huge reach, or specialized players like CrowdStrike and Palo Alto are fighting hard for every customer.
So the market's saying their edge might be fading.
Or at least the path to growth looks tougher than before. That leads to the downgrade, the stock dip. Even though demand for cybersecurity itself is strong, it's about maintaining that competitive advantage.
Okay, and Figma, that sounded more like valuation.
Exactly. Figma's case is different. It's mainly about valuation, a classic story in high-growth tech. A company can have amazing tech, a great product, clear growth potential. But if its stock price already reflects super optimistic future growth, if it's priced for perfection, you could say.
Then any hiccup causes a drop.
Precisely. Any slight worry about more competition, losing market share, maybe AI monetization being slower than hoped, that can trigger a big sell-off. Investors adjust their expectations, and the stock price corrects to what seems like a more realistic value. Those neutral ratings from big analysts basically say, great company, but the price is too high right now, not much room for error.
Got it. Valuation versus competition. And the xAI lawsuit, that seems like a totally different beast. Less about market forces, more about the rules of engagement.
It absolutely is. The xAI suit brings in another critical factor, the legal and regulatory environment. These kinds of fights, especially involving huge tech companies and basic competition questions, create massive uncertainty.
Regardless of the tech itself.
Right. The prospect of long, costly lawsuits, potential regulatory changes that can weigh heavily on how investors feel, no matter how good the underlying tech is. It shows that even in innovation, market dynamics, valuation, competition, and the legal framework are all critical for a stock's performance. And that includes companies like Adtest, the semiconductor equipment maker. They fell just on the mention of export restrictions by Trump.
Wow, just the mention.
Yeah. Even if long-term AI demand is strong, those short-term political risks can have immediate, real negative profit impacts. It's a much bigger picture than just the technology. It's a whole ecosystem, innovation, regulation, market feeling.
Okay, that was a deep dive into the US and global tech. Let's widen the lens again, check the pulse on other major markets, especially in Asia, because this whole financial story is so intertwined. Starting with Singapore, we saw that fifth straight day of gains, driven by US rate hopes and good local CPI data. Real estate REITs like Mapletree and Frasers were strong, as we mentioned. But interestingly, big regional players like Jardine Matheson and the banking giant DBS Group saw declines. That highlights a kind of selective market, right? Certain sectors doing well, others maybe seeing profit-taking.
Yes, Singapore is a great example of a market riding global waves, but with its own distinct currents. The strength in real estate, helped by U.S. rate hopes and local confidence, was clear. It shows how outside catalysts can really resonate locally.
Right.
But the declines in some of the bigger diversified names like Jardine and DBS show that even in a rising tide, not all boats lift equally. Could be profit-taking, like you said, or maybe sector-specific issues separate from the broader optimism. It definitely suggests investors are being very choosy, looking past the headlines.
And Japan had an interesting day, too. After that initial Powell boost, the Nikkei's gains kind of fizzled. Profit-taking, caution about high valuations after July's rally, and also worries about the yen getting stronger if the Bank of Japan hikes rates.
Multiple factors weighing on it.
Yeah. But what really stood out was the Nikkei Average High Dividend Stock 50 Index hitting a record high, driven by people buying ahead of interim dividends and this general shift to value stocks as domestic long-term interest rates hit 17-year highs.
A flight to yield and safety.
Seems like it. Mitsui, Kinzoku, NTN, INPEX saw big rises. Investors needed to buy by Sept 26th for those dividends. Also, Japan's Corporate Service Price Index for July raised 2.9% year-on-year. Slower than June, but still showing businesses passing on costs, especially labor costs.
You've picked out some really key nuances for Japan there, and the high dividend stock action is particularly revealing. Each market has its own beat, but they all hear the global music. In Japan, high dividend stocks get really popular precisely because they offer a relatively stable income stream.
Especially when rates are rising.
Exactly. When long-term rates are up, making regular bonds less attractive, and when people are maybe cautious about the broader market rally looking stretched, high dividend stocks look good. It's a classic flight to quality and yield, seeking reliable returns in uncertain times. A defensive move.
And the dividend deadline buying.
That's a well-known pattern there, buying before the cutoff date, a calendar effect. And that corporate service price index, even though it's slowed a bit, still shows costs, especially labor, are being passed on. That sustained upward pressure on prices is something the Bank of Japan will watch very closely as it thinks about policy, maybe adding to expectations of a rate hike, especially with those 17-year high long-term rates. All these things create Japan's unique investment climate right now.
Understood. So Japan's playing defense, seeking stability and income. What about India and Hong Kong? What were the key things happening there?
In India, stocks bounced back on August 25th, the Sensex up 0.4%. They also got a lift from U.S. rate cut hopes, plus some positive analyst upgrades for big IT service companies like Infosys and Tata Consultancy. Shows how U.S. policy hopes can boost sentiment for export-focused sectors in emerging markets.
But there were worries, too.
Yes, weakness was expected for the 26th. Partly profit-taking, but also, crucially, the looming threat of an additional 25% U.S. tariff kicking in on the 27th. That was expected to curb risk appetite, especially since the market would be closed that day. Highlights the immediate chill from trade policy uncertainty.
Got it. And Hong Kong?
Some interesting company news there. Huawei is strategically restructuring its cloud business to focus more on AI, suggesting a needed shift as that unit faced losses, responding to market demand and maybe geopolitical pressures too.
Okay.
Heidelao, the big hot pot chain, reported a 13% drop in net profit year-on-year for the first half of 2025, missing expectations. Revenue was down 4%. The reason? Intense competition in China's restaurant scene.
Does that tell us anything broader?
It can. A micro-level story like that about a popular consumer brand can sometimes signal wider trends like maybe slowing consumer spending on non-essentials or just too many players in that sector.
Interesting. What else from Hong Kong?
On consumer trends, China Customs seized almost 2 million counterfeit Pop Mart LBBU toys. Shows stronger IP protection efforts, which is good for brands, but also shows the challenge is still there. Chow Tai Fook, the jeweler, raised prices 5.13%, its second hike this year. But analysts worried hikes under 10% might squeeze margins, shows the tough balancing act for retailers. And HSBC lowered some fixed-rate mortgage rates in Hong Kong, down to 2.73% for the first 3 or 5 years, explicitly anticipating a U.S. rate cut in September. Another direct link showing how closely Hong Kong finance tracks the Fed.
That's a lot of different moves across Asia. How do we make sense of what news matters most for each market? Like, why are high dividend stocks suddenly hot in Japan? And what does a hot pot chain's profit drop really tell us about the bigger economy? It feels like trying to read tea leaves sometimes.
That's really the art of market analysis, isn't it? Pulling together the micro and macro signals into something coherent. You can feel like reading tea leaves, but there are patterns. Each market, as we've seen, has its own pulse, but they're all connected by global currents, especially U.S. monetary policy and trade.
Okay.
For Japan, as we discussed, high dividend stocks look good because they offer stable income when maybe the broader rally seems shaky and domestic rates are rising. It's a classic flight to quality and yield strategy in uncertain times.
Right, the defensive move.
Exactly. And the hot pot chain's profit drop in Hong Kong, or those falling U.S. furniture stocks we talked about earlier, those are great examples of micro-level signs pointing to broader trends. Heidelao's intense competition could suggest slowing consumer spending or maybe just oversaturation in that part of China's economy.
Reflecting a tougher environment.
Could be. And the furniture stock slump. That directly shows the real-world impact of geopolitical trade policy on specific industries. These specific examples, they make the abstract economic forces feel very concrete, both for investors and for regular consumers like us. They help us see how global shifts actually play out on the ground, affecting real businesses and real prices.
That definitely helps connect the dots. Now, let's zoom right in on some company-specific news in Japan because these individual stories often light up bigger industry trends. Nissan Motor shares plunged sharply, 6.74% on August 26th. Reports that Germany's Mercedes-Benz Group was selling its Nissan shares, worth around $346 million.
Sold by their pension fund, yeah.
And Mercedes said the shares were no longer strategically important. Ouch. Plus, Nissan also fell out of the top 10 in global new car sales for the first half of 2025. Analysts saw it as a clear sell signal, weak core operations.
You've nailed the key point for Nissan. It's not just that Mercedes sold, it's why they said they sold. No longer strategically important. That sends a really strong message across the auto industry and to investors.
Like a vote of no confidence.
Pretty much. It signals a lack of belief in Nissan's long-term competitive path, especially with a massive shift to EVs and autonomous driving. Add in falling out of the global top 10 sales. That raises serious questions about Nissan's basic strategy, its innovation, its ability to compete going forward. It goes way beyond just a short-term market reaction. It touches deep strategic worries.
And speaking of car companies, Toyota shares fell 1.17%. That was linked back to the yen strengthening after Trump dismissed Governor Cook, right?
Exactly. The currency impact we discussed.
A stronger yen makes Japanese exports pricier, cuts the value of overseas profits when brought back to yen, hits Toyota's bottom line. They announced extending some shareholder e-money benefits, but analysts basically said, nice gesture, but limited impact. The stock's more sensitive to big institutional investors.
That's right. Toyota's situation really highlights how direct and immediate currency swings impact major exporters, especially one of Toyota's size. Even a global giant feels it. A stronger yen erodes overseas earnings and makes their cars cost more abroad, potentially hurting sales and margins.
And the shareholder perk doesn't move the needle.
Not really for the big picture.
Yeah.
It's positive for individual retail holders, good engagement, but it just doesn't outweigh the macro currency headwinds or the focus of large institutional investors who drive most of the trading in such huge stock. They're watching the bigger financial numbers affected by the exchange rate.
Okay, moving to some other interesting Japanese names. QPS Institute for Satellite Development, their stock jumped significantly, 8.35%. SMBC Nikko Securities raised their target price quite a bit, kept their top rating.
What was the reasoning?
Potential from overseas defense projects expected to grow starting around fiscal year ending May 2028, leveraging the satellite's imaging capacity relative to sales volume.
That's a very positive story for QPS. It shows how growth in specific sectors, especially niche but high-value areas like space tech and defense, can really get analysts excited. The key there is the potential for scalable growth, meaning using their existing imaging capacity, their satellites, to win new high-value defense contracts overseas. That suggests they can boost revenue significantly without a proportional jump in spending, leading to better profit margins. That looks very attractive to investors seeing long-term potential in that specialized market.
Then there's Daiichi Kogyosaku, or Ichikoyaku. Their stock fell 7.84%. Concerns about near-term supply and demand after they announced plans to dispose of 1 million treasury shares, that's 9% of total, and sell another 337,400 shares held by Mizuho Bank and Asahi Life Insurance, about 3%.
So a lot more shares potentially hitting the market.
Exactly. The moves were aimed at strengthening finances for growth and increasing the free float, the shares available for trading, maybe to get included in major indices like Topix. But analysts noted the company's performance is still solid, so maybe buyers will step in at lower prices.
Yeah, that's a classic short-term supply-demand reaction. More shares coming available often creates selling pressure initially as people anticipate the new supply potentially diluting existing holdings.
Even if the long-term reasons are good.
Right. Even if strengthening finances and aiming for index inclusion are strategically smart long-term goals, the immediate effect is just more shares out there. But that analyst comment about solid performance and potential buyers at lower prices is key. It suggests this might be a temporary dip for those who believe in the company's fundamentals and strategy, separating short-term noise from the long-term view.
I see. Okay, on a brighter note, Shimamura, the fashion retailer, stock up 4.27%. Their August same-store sales rose 1.2% year-on-year. That's 5 straight months of growth.
That's pretty consistent.
Yeah. Average customer spending dipped slightly, like 0.5%, but customer numbers rose 1.3%. Hot weather helped sales of parasols and hats, but trendy autumn women's wear also did well, showcasing good product strategy.
Shimamura's performance is a great example of retail resilience. It shows how being agile and having the right products at the right time can really work. Even with average spending down a tiny bit, getting more customers in the door and selling both seasonal necessities like hats for the heat and trendy new autumn stuff. That shows they really understand their customers and manage inventory well.
Adapting well.
Exactly. Adapting to weather, fashion trends, capturing spending even when the economy has crosscurrents. That's a big positive for investors looking for stability in retail.
Okay, nearly there. Mitoku Engineering stock kept declining, down 1.74%. News came out that City Index 11, that's linked to the old Murakami Fund, and another investor partially sold their joint stake.
Reducing their holdings.
Yeah, down from over 5% to just under 4%. That led to profit-taking, less speculation about big management changes maybe, though some market folks think the decline might be limited because people still expect shareholder returns.
Right. That's a clear case of sentiment shifting based on what prominent shareholders do. When a known activist group like City Index 11 starts selling down, it often signals they're less optimistic about big changes, or maybe just locking in profits. Others might follow, creating selling pressure.
But maybe not a total collapse if fundamentals are okay.
Possibly. The mention of ongoing expectations for shareholder returns suggests there's still a baseline belief in the company's value that could cushion the fall, especially among long-term investors focused on capital return.
And finally, totally different sector, Ajinomoto, Malaysia. The food company based there reported strong April-June profit up 28%, driven by strong umami seasoning sales in the Middle East and lower raw material costs. Sales up 6% too.
That's an excellent example of specific product success and good cost management driving strong results in a regional market. Robust sales of their core product in a key export market like the Middle East, plus lower input costs. That's a recipe for a very healthy profit boost. Shows the power of successful international sales and efficient operations in the food sector.
All right, let's shift one last time to the broader economic picture in the U.S. and key commodities. We've got this snapshot of July and August data, and it really paints a mixed picture, doesn't it?
It certainly does. A bit of everything.
Housing market. Conflicting signals. July new home sales down 0.6% month-on-month, but existing home sales up 2.0%. Housing starts rose 5.2% in July, but building permits, which look ahead, declined, and the housing market index dipped slightly in August.
Yeah, not a clear trend there.
Labor market. Initial jobless claims ticked up a bit for the week to 235,000. Manufacturing and services. The Philly Fed Manufacturing Index dropped into contraction territory in August, negative 0.3. But the broader S&P Global PMI figures for August showed expansion composite at 55.4, with both manufacturing and services above 50.
So regional weakness, but broader expansion.
Seems like it. And finally, oil inventories showed slight decreases across crude, gasoline, and heating oil diesel for the week. That's a whole lot of numbers, and they really seem to be pulling in different directions. What do these indicators, taken together, tell us about the actual health of the U.S. economy right now? Are we looking at solid growth, a clear slowdown, or just something way more complicated and in between? Feels like a jigsaw puzzle where some pieces don't quite fit.
You're absolutely right. It is a mixed bag, a puzzle indeed. No single number tells the full story. But when you look at the whole picture, you see some resilience in existing home sales and starts, despite the dip in new sales. The labor market seems generally stable, even with that small rise in claims. And importantly, the services sector, which is the bulk of the U.S. economy, shows robust expansion even if manufacturing looks a bit cautious.
Okay.
Taken together. It paints a picture of, let's call it, nuanced growth. It's definitely not a runaway boom, but it's not signaling a clear slowdown either. It's a complex economy, adapting. And this mixed signal, that's precisely what gives the Federal Reserve both the data and the dilemma.
The dilemma being?
Do they need to rush into rate cuts when parts of the economy still look resilient? Or can they afford to be more patient, more data-dependent, without risking too much of a slowdown or letting inflation reappear?
That's a very clear way to frame it. Nuanced growth. So not a housing crisis, but not a crazy boom. And it looks like services are really doing the heavy lifting if manufacturing is a bit hesitant.
Precisely. The housing market shows underlying demand, maybe helped by earlier rate cut hopes or demographics, keeping it from falling apart. Not roaring, but not dead. Labor market. Stable overall, minor fluctuations.
And manufacturing versus services.
The Philly Fed manufacturing number is cautious, worth watching. But the broader PMI data, covering both, shows expansion overall, especially in services which remain strong, driving a lot of activity. This mixed picture highlights the economy's adaptability, but also the tricky job policymakers have right now.
Okay, moving finally to commodities. Some interesting action in oil and gold. WTI crude oil futures rose for a third day, closed at $64.80 a barrel, up 1.8%. Why the surge?
Several factors there. Concerns about Russian crude supply, stagnating Ukrainian drone attacks, are estimated to have cut Russia's refining capacity by maybe 17%.
Wow, that's significant.
Plus, escalating military tensions between Venezuela, an oil producer, and the U.S. Worries about Chevron's oil imports stopping, U.S. warships deployed, adds to supply fears.
Geopolitical risk premium.
Exactly. And expectations of Fed rate cuts also provide some underlying support, as lower rates can sometimes stimulate demand for energy.
And gold. It slipped slightly in New York December contract at 3,417 pounds, 5 cents past per ounce, down $1. Why?
Primarily due to a stronger U.S. dollar against other major currencies. Gold is often priced in dollars, so when the dollar strengthens, gold tends to become more expensive for buyers using other currencies, which can dampen demand. It often moves inversely to the dollar.
But didn't it rise in Japan?
It did, initially. Domestic Japanese gold trading saw gains extend for a fourth day. That reflected increased safe haven buying there, specifically linked to those concerns about Fed independence after Governor Cook's dismissal we talked about earlier. Local factors boosting safe haven appeal.
It's always amazing how fast global events, like conflicts or political moves, hit our wallets at the pump or in investments. How does that connection work so fast for something like global crude oil? And on the flip side, why is gold always the go-to safe haven when things get uncertain?
Those are great fundamental questions about how global markets and, frankly, human psychology work in uncertain times.
Yeah.
Let's take crude oil first. It's a truly global market. Think of it like one huge shared swimming pool.
Okay.
When there's a supply disruption anywhere, conflict hitting Russian refineries, tensions potentially stopping Venezuelan exports, it affects the water level in that entire global pool. Even if the disruption's far away, if the total supply flowing in tightens, prices tend to rise everywhere.
Affecting the global balance.
Exactly. And those higher crude prices eventually trickle down, leading to higher gas prices at the pump for you and me. It's a basic economic principle playing out globally, showing how interconnected everything is. A local event can have global cost impacts.
So even if the oil wasn't coming directly here, the global pool shrinks, raising everyone's price. Powerful analogy.
Exactly, the shared pool effect.
Yep.
Take water out one side, the level drops everywhere. Now gold, yes, it's a shiny metal, but financially it's much more. It's considered the classic safe haven asset.
Why?
When there's political or economic uncertainty, when confidence in traditional investments like stocks or currencies drops, like with those Fed independence worries, or geopolitical instability, investors often run to gold as a store of value.
Because it's tangible.
Partly that. It's seen as a tangible, finite asset that has historically had its value pretty well during turbulent times. It's like a universal currency that doesn't depend on any single government or financial system being stable. That inverse relationship with the dollar often comes from its pricing. A stronger dollar makes gold costlier for non-dollar buyers, potentially dampening demand. But that safe haven urge, especially during times of systemic worry, can often override that dollar effect, leading to buying, especially in markets like Japan, where local concerns amplified that feeling. So to wrap up our deep dive today, what we've really seen is how global markets are constantly trying to balance these carefully planned signals from central banks against the sudden, unpredictable shocks from politics and trade policy.
A real balancing act.
Absolutely. And meanwhile, the AI revolution just keeps charging ahead, fundamentally reshaping industries, creating huge opportunities, but also massive disruption for older business models. And under these big themes, we see all the intricate details, individual company stories, regional economic differences, commodity swings, painting this picture of a truly dynamic and, often volatile global economy.
It feels like everything's connected now more than ever.
It really does. What's fascinating is how politics, technology, and monetary policy are increasingly intertwined. It creates this landscape where maybe the traditional economic numbers don't fully capture how fast things are really shifting, which leads to the big questions we should all be thinking about.
Like what?
Well, what unexpected black swan events might pop up from these tangled, sometimes conflicting forces? And how can investors, businesses, how can you listening not just react, but actually prepare for a future that seems defined by this kind of volatility and rapid change? It demands we keep learning, keep thinking critically, keep asking those questions, keep digging, and keep learning with us. Thank you for joining ZT Financial.